All right, let's jump into this deep dive.
Mhm.
Today, we're going to be looking at the story of a young investor, Eugene Low. He's on a mission to become a millionaire by 33, and we're going to be breaking down how he plans to get there. We're dissecting a YouTube video from CNA Insider called A Gen Z Investor's Strategy to be a Millionaire by Age 33 Money Mind Investment. And yeah, there's a lot to unpack here. He's already built a pretty impressive portfolio at only 20 years old. But what's really interesting is how he's done it. Early investing, the power of dividends. But here's the thing. This Gen Z investor is steering clear of crypto.
So let's dive in.
Yeah, it kind of goes against like the stereotype of how young people invest these days.
Right, exactly. So the video starts with Eugene taking part in this financial literacy challenge in Singapore. It shows him hunting for QR codes all around the city. And he's learning all about budgeting and saving and even like the costs of renting. So you can tell this isn't just about luck. Like he's actively putting in the work to really understand, the financial world. Yeah, and what's really cool is that his journey actually started way earlier.
Hmm.
The video mentions how his parents got him into paper trading when he was only 14.
Wow.
Yeah, and that early exposure to financial concepts can be so important, it can make a huge difference.
Totally. And it seems like it really lit a fire under him. There's this great story in the video where Eugene talks about how his spending has changed over the years. As a kid, his favorite treat was a $5 McDonald's meal.
Ah,
I
clout.
mean, who hasn't been there? But now he splurges on things like concerts, which can easily cost like over $200. It perfectly illustrates how our financial priorities shift as we get older.
For sure. I mean, it's not just about what we want, right? Like, as we take on more responsibility, our needs also change. And so managing our money effectively becomes even more important.
For sure. And Eugene realized pretty early on that just saving money wasn't going to be enough.
Hmm.
He wanted his money to work for him, so he started investing at 15.
Hmm.
I'm curious, for those who might not be familiar with like the whole investing thing, what does it actually mean to like shift from saving to investing?
Yeah, that's a good question. And it's a really big shift in mindset. When you're just saving, your money's just sitting in the bank, maybe earning a tiny bit of interest. But when you invest, you're putting that money to work. You're putting it into assets like stocks or bonds with the goal of growing your wealth over time. It does involve some risk, but it also has the potential for way higher returns.
Right. Okay, that makes sense. So Eugene started investing with something like $2,000 to $3,000, mostly from like savings and those red envelopes you get during Chinese New Year, the lucky money.
Oh, yeah.
Over the next few years, he consistently added about $6,000 every year to his portfolio. And get this, he reinvested all of his gains. So by the time he turned 20, his portfolio was worth $50,000.
That's incredible. It really shows the power of like consistent contributions and compound interest,
Yeah.
right? Even small amounts invested regularly can really snowball over time.
It's amazing, right? I mean, you've talked about starting early and the magic of compound interest before. But what's interesting here is that Eugene is really into dividend-paying stocks, especially as a student who needs some steady cash flow. Can you break down what dividend investing is and why he might be drawn to it?
Sure. So dividends are basically a portion of a company's profits that are paid out to shareholders. So it's like you're getting paid just for owning a piece of that company. Now, not all companies pay dividends, and those that do will have different dividend yields and payout ratios. Dividend investing can be a great way to generate passive income and create a more stable cash flow.
So instead of just relying on the stock price going up, he's also getting regular payouts from these dividends. Seems like a pretty smart move for a student, right? Especially if you need some extra cash.
Exactly. And for Eugene, it seems like a good fit, He needs more predictable income while he's still studying.
Okay. Before we move on, there's something that might surprise some people. Eugene is actually avoiding investing in two things that are really popular right now: cryptocurrency and commodities.
Yeah, that's a really interesting choice. It shows a lot about his investment philosophy. He really believes in staying within his circle of competence, which basically means he only invests in what he truly understands.
So he's not jumping on any bandwagons or chasing, like the latest trends. I respect that. But what does it actually mean to understand an investment? Like, what's he looking for when he's researching companies?
He's focusing on what we call the fundamentals of a company. These are like the core financial indicators that tell you about the company's long-term health and profitability. So things like their earnings, how much revenue they're bringing in, their debt levels, and also like the overall strength of the industry they're in.
So he's doing his research, understanding the businesses before putting his money in the smart approach. But let's face it, even with all the research in the world, investments can be affected by, how the market is doing. The video mentions how Eugene's portfolio was impacted by the ups and downs during the pandemic and the recent global instability.
Mm.
So how did he handle all of that? Did he stay calm or totally freak out?
Well, what's really impressive is that he didn't just react out of fear. He stayed focused on why he invested in those companies in the first place. And he kept an eye on how they were performing, those fundamental indicators we talked about.
So basically, he weathered the storm by trusting his research and not making any rash decisions based on short-term market changes.
Exactly. And that brings us back to his big goal of reaching $1 million by 33. It's pretty ambitious, right?
It definitely is. You mentioned diversification earlier, but isn't he already kind of diversified by focusing on dividend-paying companies in different sectors?
Well, yeah, investing across sectors is a good start. But true diversification means spreading your investments across different asset classes, different regions, and even different investment strategies. The video hints at Eugene maybe looking into U.S. stocks and the S&P 500. Those could offer him some more growth opportunities.
So adding some U.S. stocks to the mix could be a smart move, potentially boost his portfolio's growth. What else could he do to, increase his chances of hitting that $1 million mark?
Well, keeping up those consistent contributions is key. The more he can add to his portfolio, the faster it'll grow, especially with that compounding effect working its magic.
Right, like adding fuel to the fire. But there's something else coming up that could be a challenge. His national service. The video mentions it, and he doesn't seem too worried about how it might affect his investments.
That's a great example of his long-term mindset. He knows that national service will mean less time to, actively watch his stocks, and it's cool with that. He's playing the long game here. Those short-term market swings don't really faze him.
That's pretty impressive.
Hmm.
Most investors I know are constantly glued to their screens, checking every little market move. But Eugene's taking a step back and trusting his strategy. Speaking of his strategy, we've talked about him liking dividend-paying stocks, especially as a student who needs some regular cash flow. But are there any downsides to that approach? Is it really the best strategy for someone with such long-term goals?
That's a really good question. And it highlights how important it is to understand, all the ins and outs of any investing approach. Dividend-paying stocks can give you some stability and regular income, but they might not always offer the highest growth potential.
So he might be missing out on some potentially explosive growth in areas that don't typically pay dividends, like maybe tech companies?
Yeah, it's definitely a possibility. It's all about finding the right balance between that stability and the potential for big growth. That's another reason why diversification is so important. He might want to allocate part of his portfolio to growth stocks to try to capture those potentially higher returns.
Okay, that makes sense.
Yeah.
So should he just ditch those dividend stocks altogether and go all in on those high growth companies?
Not necessarily. It's not about picking one or the other. It's about building a portfolio that matches his risk tolerance, his time frame, and his financial goals. Maybe he could look into different types of dividend-paying stocks, some that offer both steady dividends and some potential for growth.
Ah, so finding those hidden gems that can do both.
Exactly. And as his investment journey goes on, he can adjust his strategy, learn from his experiences, and just adapt to, how the market changes. It's never a static thing.
This really emphasizes that investing isn't a one-size-fits-all thing. It's about creating a personalized approach that works for you, your situation, and what you want to achieve.
For sure. And it's a continuous learning process. Even experienced investors are always adapting, refining their strategies, and keeping up with market trends.
Speaking of staying informed, Eugene isn't just focused on his own financial success. He's actually started a social media initiative to share what he's learned and encourage other young people in Singapore to take charge of their finances. It's pretty cool that he's taking the time to teach others about financial literacy.
Definitely. It shows how much he believes in financial education and his willingness to give back to his community.
Now, we've covered a lot about Eugene's investment strategy, his discipline, and his long-term vision. But honestly, aiming for $1 million by 33 is super ambitious. Are we just focusing on someone who's an exception to the rule? Or are there actually some valuable lessons here for our listeners, even if they're not trying to become millionaires? What can we learn from Eugene's journey that can be applied to anyone's financial life?
His story is a powerful example that you don't need to start with a ton of money to be successful financially. What you need is dedication, a willingness to learn, and a commitment to taking action consistently.
So it's not about being born rich. It's about taking those small steps no matter where you're starting from.
Right. And it really shows how important financial literacy is. The more you understand about money, investing, and making your money work for you, the better prepared you'll be to reach your financial goals, whatever those goals might be.
Knowledge is power, right. So what are some things our listeners can do, like right now, to start building their own path to financial well-being, even if it's not $1 million goal?
The first thing is to set clear financial goals. What do you want to do with your money? Buy a house, start a business, retire early, or just have a nice financial safety net.
So having a clear vision of where you want to go is important. It's like having a destination in mind before starting a trip.
Exactly. Once you've got those goals, create a budget and track where your money's going each month. This will help you figure out where you can save more and free up money to invest.
So it's not just about earning more. It's about being smart about how you're spending what you already have.
Exactly. And don't be afraid to look for information and resources. There are tons of books, articles, podcasts, online courses that can teach you the basics of personal finance and investing.
Yeah, learning is a lifelong process, especially with all the changes happening in finance.
Yeah.
But it doesn't have to be overwhelming. Start with the basics, build up your knowledge gradually, and ask questions. Don't be shy about it. There are so many resources and experts out there who are willing to help.
Absolutely. And remember, you don't have to do this alone. Get advice from financial advisors or find a mentor if you need to.
It's like having a coach in your corner, right?
Right.
Cheering you on and helping you navigate the financial game.
And this is super important. Building wealth is a marathon, not a sprint. Be patient, stay focused, and don't let setbacks or market swings get you down. Time is on your side, especially if you start early and stick with it.
So even if you're not aiming to be a millionaire by 33, Eugene's story is a great example that with the right attitude, knowledge, and habits, anyone can take control of their financial future and create their own version of success. It's really inspiring to see someone so young being so proactive and responsible with their finances.
Yeah, for sure. And it's not just about hoarding wealth. He's actually using his knowledge to help other people, which is pretty awesome.
Totally. Now, before we wrap up this deep dive, I want to come back to Eugene's $1 million goal. We've talked about the steps he's taking, but honestly, how realistic is it? Like, what are the things that could help him reach that goal, or maybe stop him from reaching it?
It's a big goal, that's for sure. But it's not impossible. I mean, remember, he already has a solid base with that $50,000 portfolio. And with his consistent investing, and if he builds a well-diversified portfolio, there's definitely potential for some serious growth.
So he's motivated, he's got a plan, and he's already off to a good start. But are there any, external factors that could mess things up?
Well, yeah, the market plays a huge role. And we can't really predict what's going to happen with the global economy. Unexpected things like a sudden recession or some big geopolitical event could definitely affect how the market performs.
So even with the best planning, there's always some uncertainty. It's a reminder that investing always involves some risk.
Right. And that's why it's so important to think long-term and not panic when the market goes up and down. Eugene's approach of focusing on the fundamentals of those companies and riding out the volatility is going to serve him well.
So he's not looking for quick wins or trying to time the market. He's playing the long game.
Exactly. And that long-term mindset, plus his willingness to keep learning and adapting, will definitely increase his chances of success.
It's like he's running a marathon, not a sprint. Pacing himself, staying focused, and adjusting to the changes along the way.
That's a great way to put it. And it shows how important it is to have a plan, but also be flexible enough to change that plan if you need to. The investment world is constantly changing, and the people who succeed are the ones who can adapt and learn as they go.
So for our listeners who are inspired by Eugene's story but maybe feeling a little overwhelmed, what's the one piece of advice you would give them as they start their own financial journey?
I'd say focus on the things you can actually control. You can control how much you save, what you invest in, and how much effort you put into learning about finances. Don't get caught up in things you can't control, like what the market's doing or trying to predict the economy.
So it's about taking charge, getting informed, and making those small, consistent choices that will add up over time.
Exactly. And remember, financial success isn't just about hitting a specific number on your bank statement. It's about creating a life where you're financially secure and you have the freedom to do the things you love.
Well said.